The majority of traders fail because their risk management is based on arbitrary numbers, not market structure. Conventional wisdom dictates placing a stop loss based on a fixed percentage, 1% or 2% of capital risked per trade. This method is easily quantified but fundamentally flawed. It ignores the professional reality of the market. Alternatively, traders place stops just beneath the most recent swing low or just above the most recent swing high. This approach is marginally better because it acknowledges price action. However, these visible areas of support and resistance are also the most obvious liquidity pools. Professional operators know exactly where these stops are clustered. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. The market routinely moves just far enough to capture that easy liquidity before reversing sharply. This is the classic shakeout. It is designed to harvest the stops of the weaker conventionally managed positions. A stop loss placed one tick below a prior low is essentially a donation to the professional composite operator. It is the most vulnerable position possible. Richard Wyckoff observed this pattern repeatedly in the early 20th century. He recognized that the common methods of risk management were designed to fail the retail operator. They forced premature exits at the exact moment the market was preparing for its intended move. The fatal flaw is the definition of risk itself. For the conventional trader, risk is defined by a monetary amount or a percentage drop. For the professional trader operating under Wyckoff principles, risk is defined by structural invalidation. If the underlying market structure remains sound, the position should be maintained. If the structure is violated, the position must be exited immediately, regardless of the percentage loss involved. Wyckoff's core principle is that a trading range exists for a reason: to accumulate or distribute stock. The professional must respect the boundaries of that entire structure. Placing a stop inside the structure violates this respect. It assumes the accumulation or distribution process is complete before it truly is. Wyckoff taught that the stop loss must be placed outside the entire operational structure. It must be positioned where the market's behavior signals a fundamental change in the relationship between supply and demand. Anything less is simply noise. The conventional definition of risk is purely numerical. It relies on a specific dollar amount. It uses a fixed percentage of capital. Richard Wyckoff taught that this approach fails to account for market reality. Wyckoff's primary definition of risk is structural invalidation. Structural invalidation means the market has signaled a fundamental failure of the current operating hypothesis. If the professional trader hypothesizes accumulation, that structure must be maintained. The entire trading range represents the process of accumulating shares. It is the period where the larger interests absorb the floating supply. This absorption creates the cause necessary for a future markup. The structure is the cause. If the structure fails, the cause is abandoned. A trade hypothesis is invalidated when the price penetrates the boundaries of the established range. This penetration confirms that the relationship between supply and demand has fundamentally shifted. For an accumulation structure, the critical boundary is the low point of the entire range. This low is usually established by the initial selling climax and confirmed by subsequent secondary tests. A definitive break below this low signals that the composite operator failed to absorb all available supply. Supply remains dominant. The market is not ready for the markup phase. The structure has been invalidated. The hypothesis of accumulation is canceled. Therefore, the only logical place for risk management is outside the entire structure. The stop loss must be positioned where it confirms this failure, not where it merely reacts to short-term volatility. Placing a stop within the boundaries of the trading range assumes the structure is sound. This placement exposes the position to high-probability shakeouts and spring events designed to capitalize on shallow stops. Wyckoff understood that the temporary penetration of an internal support level is noise. The decisive penetration of the entire structural boundary is a message. That message indicates a necessary reversal of the trading position. The market is communicating that the expected move is no longer possible. The structure meant to build the cause has failed to hold. Risk is defined by the depth required to confirm this failure. The concept of structural risk is rooted deeply in the principles laid down by Richard Wyckoff. Wyckoff codified his market observations into three fundamental laws. The law of supply and demand dictates the direction of price movement. The second is the critical law of cause and effect. The professional trader must understand this relationship completely. The cause is defined by the necessary construction phase. This construction phase is the trading range itself. It is the area where professional interests are either accumulating inventory or distributing holdings. This process requires significant time. It demands specific, observable price action. The effect is the ensuing trend. It is the powerful markup or markdown that follows the completion of the trading range. Wyckoff observed that the magnitude of the effect is directly proportional to the size and duration of the cause. A long, wide accumulation promises a substantial move higher. A narrow, short accumulation suggests a smaller subsequent trend. For the expected effect to occur, the cause must remain structurally sound. If the structure intended to build the cause is broken, the energy required for the subsequent move is dissipated. The entire operational premise of the trade is invalidated. The trading range must hold its critical boundaries. Consider an accumulation structure. The professional money requires the entire range to successfully absorb the available supply. They must buy all shares being offered at the lower prices. If the price breaches the established floor of the accumulation, it signals that supply was not fully absorbed. Too much inventory remains in weak hands. This structural failure means the expected markup cannot happen in the immediate future. The smart money has failed to complete its operations successfully. Therefore, the structural boundary is not merely a convenient place for a conventional stop loss. It is the precise point of invalidation for the entire trading thesis. The cause has failed. The effect is nullified. The depth of the trading range from the absolute low to the absolute high defines the required depth of the structural stop. The entire engineered cause must be protected. Price action moving outside this structure confirms a change in market control. The depth of the trading range defines the absolute minimum requirement for structural protection. The first step in implementing structural risk management is identifying the two major boundary points. These points define the volatility envelope of the initial accumulation structure. The lowest boundary is established by the selling climax. This is the culmination of intense downward pressure. It is characterized by massive volume and often wide price spreads. The selling climax signifies the final panicked capitulation of weak holders. This event marks the point where professional interests step in forcefully to absorb the overwhelming supply. It is the exhaustion point for the selling pressure. Following this dramatic exhaustion, the market immediately reverses course. This swift upward movement establishes the upper boundary. This move is called the automatic rally. The automatic rally occurs because the intensity of the selling climax has effectively cleared the market of remaining sellers. Demand suddenly meets little resistance. Price rapidly advances until supply re-emerges. The highest point reached during this initial, strong reaction defines the temporary ceiling of the trading range. The distance between the low of the selling climax and the high of the automatic rally is extremely important. This distance establishes the preliminary trading range. It dictates the initial volatility and the required depth for any structural stop loss. This entire range is the defined cause. It represents the area where professional accumulation is taking place. For risk management purposes, the low of the selling climax is the critical support level. Any penetration of this level signals a potential failure of the entire campaign. It suggests that the assumed accumulation is actually a continuation of distribution. A professional trader understands that placing a stop loss inside this trading range is speculative. It exposes the capital to normal market fluctuations and shakeouts. The structural stop must be placed outside the entire range. The market rarely moves directly into the next phase. It must confirm the strength of these initial boundaries through testing. The initial test of the selling climax low is the secondary test. This test is crucial for confirming the absorption of supply. It must occur on significantly lower volume than the original selling climax. If the secondary test holds above the selling climax low, the structural integrity is confirmed. The low of the selling climax remains the deepest point of protection. If the secondary test penetrates the selling climax low, the structural stop must immediately adjust. The new, deepest point of the structure becomes the low of the secondary test itself. Price action below this final structural low invalidates the accumulation hypothesis entirely. The secondary test is not merely a price point on the chart. It is a critical confirmation event. Richard Wyckoff observed that professional money must systematically confirm that selling pressure is exhausted before initiating a markup. This confirmation is the primary function of testing within the accumulation structure. The professional operator seeks to absorb available supply without driving the price higher prematurely. This absorption process requires the market to demonstrate a clear lack of aggressive sellers. A successful secondary test is always characterized by significantly lower volume compared to the initial selling climax. This volume signature is essential. If the retest occurs on high or expanding volume, it signals that supply is still readily available. Persistent supply means the structure is not yet prepared for a sustained move upward. When the test occurs on diminishing activity, it confirms the initial low boundary of the structure. This low boundary, established by the selling climax or the subsequent deepest test, becomes the ultimate line of defense for the entire campaign. Structural risk management dictates that the stop loss must be placed below this proven line of defense. Price action below this final structural low invalidates the accumulation hypothesis entirely. Testing is not confined only to the initial phase of the structure. Professional money continues to test the market throughout the consolidation period. These later tests often occur in Phase C or Phase D. These later tests are sometimes referred to as the last point of support. They serve to shake out weak holders and ensure that all available floating supply has been absorbed prior to the breakout. Each successful test reinforces the structural stop placement. The stop is not placed arbitrarily below the immediate test low, but outside the entire structural integrity established since the selling climax. Placing the stop outside the entire base acknowledges that the professional campaign must protect its entire accumulated position. They cannot allow the market to return to the deepest levels without abandoning their effort. The trading range itself represents the cause in Wyckoff's law. If the cause is broken through the lower boundary, the anticipated effect, the markup, cannot materialize. Therefore, the structural stop must be positioned at the level where the fundamental premise of supply absorption is definitively proven false. This level is always the absolute lowest point of the entire structural base. The trading range represents the entire cause. This cause is the effort of accumulation engineered by professional interests. Wyckoff taught that the stop-loss placement must respect the total effort put into establishing this structural base. The base is defined by the absolute low established during the initial selling climax phase. It also includes the price action of any subsequent secondary test. This entire area is the zone where supply was supposedly absorbed. Placing a stop-loss inside this zone is inefficient. It exposes the position to unnecessary liquidation during periods of normal market volatility. It treats a routine test as a structural failure. The only point that matters for structural risk management is the absolute lowest low of the entire range. If the price penetrates below this absolute low, the premise of accumulation is shattered. This penetration proves that the supply was not fully absorbed. It confirms that the professional efforts failed completely, or that distribution was occurring all along. The structural stop must therefore be placed outside the entire structure. It sits below the lowest point achieved by the composite operator during the entire accumulation phase. Professional traders often engineer deep reactions specifically to clean out weak holders. These maneuvers are known as shakeouts. They are designed to trigger stop losses placed by conventional traders. Conventional stops typically sit just below the most obvious support lines. They cluster below the low of the automatic rally or the high-volume low of the secondary test. These are easy targets. The structural stop, however, is positioned far below those obvious levels. It is placed where the composite operator would never intentionally drive the price, unless their own operation had truly failed. This deep placement protects the trader from routine volatility spikes and aggressive stop hunting. It ensures that the risk is reserved only for genuine structural invalidation. When the price moves below the lowest absolute low of the trading range, the market structure has definitively shifted. The expectation changes from a coming markup to a potential markdown. The structural stop loss is not about minimizing the dollar loss per share. It is about protecting the fundamental integrity of the trade thesis. A violation of the structural low signals that the law of cause and effect cannot be fulfilled. The anticipated move cannot materialize because the underlying structure was flawed. Therefore, the protective stop must be positioned outside the entire base, below the low of the initial selling climax or the lowest point of any subsequent spring or deep penetration. This is the only placement that truly aligns with the principles of structural analysis. The primary challenge for traders attempting to enter an accumulation structure is navigating the volatile events known as the spring and the shakeout. These price movements are not random. They are deliberate actions taken by professional interests. The purpose of the spring is simple: to execute a final, definitive test for remaining supply. It drives prices sharply below the established support levels of the trading range. This downward thrust is specifically designed to trap late sellers and to trigger the conventional protective stop orders of early buyers. If a trader places a stop order just below the low of a prior secondary test, that order will almost certainly be executed prematurely during a spring. Yet, the overall market structure has not failed. The spring is merely a necessary function of the market clearing process. Richard Wyckoff taught that the structural integrity of the accumulation pattern remains valid until the absolute low of the entire structure is decisively breached. The spring, by definition, must recover quickly. It must reverse and close back inside the trading range, demonstrating successful absorption. When the spring occurs, the professional trader views it as a confirmation event, not a risk event. The true risk only materializes if the market fails to absorb the supply found during that downward thrust. Therefore, the structural stop loss must be positioned below the absolute low established by the spring. This is the deepest penetration the market should experience before launching into the markup phase. If the price drives below the spring low, and especially if it drives below the initial low established by the selling climax, the structure is invalidated. This critical breach signals that the accumulation structure has failed entirely. This failure suggests that the supply was heavier than professional operators anticipated. It indicates that the cause built within the trading range was insufficient to produce the expected effect of a sustained rally. A stop loss placed correctly honors this structural reality. It acknowledges that the market noise, the volatility and stop hunting, is a natural part of the process. By placing the protective order deep outside the structure, the trader accepts a larger potential dollar loss per share. This is the necessary cost of avoiding being stopped out by noise. However, this larger risk per share is offset by a significantly lower probability of being hit by random market fluctuations. The structural stop ensures the trader only takes losses when the market narrative fundamentally changes, confirming the original structural analysis was incorrect. This risk management discipline applies equally to shakeouts that occur later in the trading range, often called terminal shakeouts. These late-stage events share the same function as the initial spring. They are the final attempts to clear weak hands before the breakout begins. In all cases of accumulation, the absolute lowest point of the entire structure provides the ultimate line in the sand. That lowest point defines the structural invalidation of the trade. The application of structural risk management is perfectly symmetrical when moving from accumulation to distribution. In accumulation, the objective is to protect a long position from structural breakdown. In distribution, the objective is to protect a short position from structural breakout. Wyckoff observed that the highest point of the entire distribution structure must hold firm. If the price exceeds this high, the premise of professional selling pressure is fundamentally invalid. This absolute high is frequently established by the buying climax, or more often by the subsequent upthrust. The upthrust is the critical event in distribution. It mirrors the spring in accumulation. It is a decisive false breakout above the established resistance of the trading range. Professional operators use the upthrust to clear out remaining short sellers and induce late buyers. They sell their final large blocks of shares into this induced demand. If the price moves structurally above the high established by the upthrust, the entire distribution phase is negated. The market is signaling underlying strength, not weakness. Therefore, the protective stop for any short position must be placed safely above the absolute peak of that upthrust. This placement ensures the trade is only stopped out by true structural invalidation. A second, equally important structural stop placement occurs later in the distribution cycle. This stop relates to the formation of the last point of supply. The last point of supply typically occurs late in Phase D. It represents the final, shallow rally back toward the critical resistance zone. This rally confirms the weakness established by the earlier break of support. When a short position is initiated near the last point of supply, the trade offers a much tighter risk profile. The tactical stop for this entry should rest just above the high of that specific last point of supply rally. This point acts as the immediate tactical invalidation. However, professional traders understand the hierarchy of risk. Even with a tactical stop at the last point of supply, the ultimate structural line in the sand remains the high of the initial upthrust. The upthrust stop protects the trade from structural failure. The last point of supply stop manages the immediate profit objective and reduces capital exposure. Both stops are necessary for rigorous Wyckoff risk control. The depth of the stop must always account for market noise. Placing the stop exactly at the upthrust high is insufficient. The stop must be placed far enough above the high to avoid common price spread and stop hunting maneuvers. The principles of structural stop placement remain consistent regardless of the market structure. When the structure is accumulation, the professional trader must focus intensely on the sign of strength. This upward movement confirms that demand has finally overcome supply. It validates the entire cause built within the trading range. Following the sign of strength, the market typically returns to test the breakout level. This pullback is known as the last point of support. This test is highly critical. It provides the final low-risk entry opportunity before the sustained Phase E markup begins. The structural stop placement now shifts its location. It moves away from the initial selling climax low or the spring low. The new critical risk point is defined by the lowest low established during the development of that last point of support structure. Richard Wyckoff taught that the integrity of the trading range must be maintained. If price breaks significantly below the last point of support, it signals structural failure. It suggests that the prior absorption of supply was incomplete. Professional money may still be trapped within the range. This deep penetration constitutes a structural invalidation of the entire accumulation thesis. Once the market enters Phase D and then Phase E, the markup should ideally accelerate rapidly. Risk management during this rapid expansion phase requires two distinct types of stops working simultaneously. The primary stop remains the structural stop. This stop is placed deliberately well below the lowest point of the last point of support structure. It must account for common market noise and spread. This stop protects the capital dedicated to the trade's fundamental premise. If this stop is triggered, the trading hypothesis has failed. The secondary stop is purely tactical. This stop is used to protect accrued profits as the rally progresses upward. It should trail the price action using volatility metrics or short-term swing lows. This tactical stop is adjusted frequently based on momentum signals. It is not tied to the original trading range structure. The professional understands that the structural stop must always be respected first. Hitting the structural stop means the market has fundamentally changed its character. It means the cause that was built has failed to produce the intended effect. Managing risk during the sign of strength and subsequent breakout is about defining the absolute point of structural failure. It is not merely about managing daily price fluctuations or noise. The stop must provide sufficient room for the new structure to breathe while protecting against full invalidation. The structural stop loss defines the absolute point of failure. Volume analysis provides the confirmation of that structure's integrity. It helps define the exact depth required to protect the position. The market's initial high-volume events establish the boundaries of the accumulation or distribution structure. A selling climax or a buying climax shows massive professional participation. This volume confirms the commitment of capital necessary to establish the trading range. The subsequent automatic rally or automatic reaction defines the opposing boundary. These two high-volume points form the basic price framework. They represent the high effort needed to shift market direction. Wyckoff emphasized the crucial nature of testing volume within the structure. Low volume on a secondary test or a spring confirms that supply has been absorbed. This is essential information for risk placement. It shows the market attempted to push lower but lacked committed selling pressure. The professional trader understands that the stop loss must sit outside this entire area of absorption. It must be protected by the high-volume foundation established earlier. If a structural stop is placed outside the entire range, volume must confirm that this placement is logical. The stop should sit just below the low-volume test area. It must still be protected by the high-volume foundation. When price trades below the structural low, the volume signature is the key to confirmation. A true structural invalidation requires high volume accompanying the break. This high volume signifies renewed professional selling pressure. It shows that the initial foundation has failed. The Wyckoff method prioritizes structural failure over minor price action. If the price closes outside the accumulation boundary, especially on high volume, the trade premise is immediately invalid. The volume confirms the effort and the result. High volume penetration confirms that the specialists have abandoned the structure. This is the ultimate signal to exit the position immediately. If the stop is hit on extremely low volume, it often signals a temporary shakeout or a final liquidity grab. However, the structural stop must still be respected. The volume confirmation simply reinforces the understanding of why the price is moving. It does not negate the rule. A high-volume break confirms that the structure is definitively broken. It eliminates the ambiguity often associated with stop hunting. The volume signature removes doubt about whether the market is merely testing or truly reversing. The professional operator requires volatility. This volatility is necessary for accumulation or distribution to succeed. The market structure, therefore, is rarely a precise, clean line. It always incorporates a buffer zone. This operational buffer is the stop hunting zone. Richard Wyckoff often referred to this essential buffer as the price spread. It is the necessary extension beyond the obvious levels of support or resistance. This spread is not accidental. It is engineered price movement designed to fulfill a specific purpose. That purpose is to absorb the remaining supply or demand. During a phase of accumulation, the composite man must induce selling. This requires pushing prices just far enough to trigger the conventional, shallow stop losses placed by the public. If those stops are too tight, the professional cannot acquire the necessary inventory. The process of accumulation fails to complete efficiently. Triggering these stops provides the necessary liquidity. It allows the professional to absorb supply without significantly driving the price higher prematurely. The structural stop-loss placement must respect this operational necessity. Placing a stop inside this engineered spread guarantees the position will be liquidated. The structural stop must be placed where true invalidation occurs. This point is always situated entirely outside the natural testing boundaries of the trading range. Wyckoff's method forces the trader to anticipate this final deliberate shakeout. It demands placing the stop where the market structure itself is definitively broken, not just tested. Modern market dynamics amplify the effect of this stop hunting zone. High-frequency trading algorithms execute these tests faster and sharper than ever before. The underlying principle remains absolutely identical, however. The market uses rapid, often low-volume thrusts to tag shallow stops and clear the order book. Recognizing the necessity of the price spread ensures the structural stop is placed defensively. It protects the position against transient market noise and manipulative tests. Placing the stop loss within the spread is effectively donating capital to the composite man. It funds the very operations designed to shake out weak holders. The structural stop must be deep enough to survive the final engineered volatility. It must only be triggered when the underlying cause for the move, the trading range, is conclusively negated. The depth of the structural stop is determined not by an arbitrary percentage. It is defined by the full extent of the market structure itself. This is the only placement that validates the Wyckoff method's reliance on structural risk. The reliance on structural risk is critical. It must now be adapted for the 21st century market environment. Richard Wyckoff developed his methods in an era of lower volatility. Today, markets are dominated by algorithmic trading. High-frequency operations amplify market noise significantly. This amplification creates wider, faster price swings. These temporary movements often exceed the precise boundaries of the established trading ranges. The professional understands that these aggressive spikes are often designed to sweep liquidity. They are intentionally hunting conventional stop losses. Therefore, the structural stop must incorporate an essential buffer zone. This zone protects the position from temporary, non-structural volatility. Simply placing the stop precisely at the level of the automatic reaction or the last point of supply is often insufficient in modern trading. The depth of this buffer should be measured objectively. It is not an arbitrary percentage. It must relate directly to the asset's current volatility profile. One effective method involves using a multiple of the average true range. This measure quantifies the average daily price fluctuation. It provides a statistical basis for calculating market noise. The structural boundary defines the exact theoretical invalidation point. The volatility buffer then extends the stop below that invalidation point. This extension creates the necessary cushion. It ensures the position is only closed when the structure is truly negated. It prevents premature exit due to rapid, non-committal price excursions. Wyckoff's approach requires acceptance of deep capital risk. It recognizes that short-term price action is frequently misleading and manipulated. The professional trader accepts the need for a significantly wider stop. This wider placement is the cost of participating in a high-probability structural move. It is the necessary price paid to avoid being shaken out by automated market mechanisms. The integrity of the underlying structure remains paramount. If the cause is still valid, the stop must protect the position from temporary deviations. If the structure is broken, the stop must be far enough away to confirm that the break is structural, not just noise. The structural stop must therefore incorporate the measured market noise. It must be placed outside the entire consolidated range, plus the added volatility buffer. This adaptation ensures that Wyckoff's principles remain robust against modern market dynamics. The implementation of this structural risk framework follows a precise three-step procedure. This process transforms theoretical analysis into concrete action. It moves beyond simple percentage-based limits. The first step requires the exact identification of the consolidated range boundaries. This range represents the market's cause being built. The professional must locate the initial extreme points that define the structure. In an accumulation structure, these boundaries are set by the low of the initial selling climax and the high of the subsequent automatic rally. In a distribution structure, the range is defined by the high of the initial upthrust and the low of the immediate automatic reaction, or the last point of supply. These points establish the high and low of the structural box. The second step is crucial for defining the true structural invalidation point. This point is not the initial boundary, it is the deepest test of that established structure. In accumulation, the critical stop-loss depth must be placed below the extreme low of the spring or the final secondary test. The market must hold this low to confirm that supply has been absorbed. In distribution, the stop must be placed above the high of the upthrust after distribution or the highest secondary test. A failure to hold this high confirms that demand has been overcome by selling. A violation of this final test signals that the structure is false. It confirms that the professional money was not prepared to defend the cause. The third and final step involves incorporating the necessary volatility buffer. The structural invalidation point defines the theoretical boundary of the cause. The professional trader must add a measured distance beyond this boundary. This added depth protects the position from temporary, non-structural price fluctuations. It ensures the position is only closed when the market confirms the original cause has failed entirely. The structural stop placement protects the entire capital commitment. Richard Wyckoff spent decades studying how professionals actually operate. In How I Trade and Invest in Stocks and Bonds, he treats trading as a serious business, stresses capital preservation, and shows why blindly averaging down and ignoring market action destroys accounts. What we've discussed in this video is a modern intraday application of those same principles. The link to this adapted edition is in the video description.